On your marks, get set, invest. When you set out to invest, you need to work out what kind of risk taker you are, so you have a better idea of what investments are right for you. Now, generally, the more risk you're willing to take, the larger your potential rewards, but also the larger the possibility of it all going horribly wrong. That's risk for you. Now, these three people have very different ideas about how much risk they can tolerate. Meet low risk. This is a character who really doesn't want to lose the money they've already got. People in this position might no longer be earning, perhaps they've retired or they're living on a small income. So they need to make sure that they don't lose their nest egg under any circumstances. Now with medium risk, meanwhile, there's a different agenda. They want to make a chunky return on their investments, but they also often have responsibilities to others. Perhaps they have some children to support, and so they can't afford to lose a lot of money if the investment climate suddenly turns gloomy. Now this is high risk, who thinks medium risk and low risk are so boring. High risk wants to see mammoth returns, and they're prepared to take a lot of risk in order to hit the jackpot. But even high risk wants to know how they can prevent the loss of their entire account, and there are steps that they can take to maximize their opportunity while minimizing what we call their risk of ruin. But what exactly do we mean by risk? So, some investors think of risk as the chance of losing a big chunk of their money permanently. Now, this doesn't happen often, but it does happen. Others think more in terms of volatility. Volatility means all the ups and downs that you have along the way. Say you want to get from point A to point B in 10 years. But if the journey takes you via this route, would you still be happy with that? Now, you probably would be happy enough if you knew that it would get to B in the end, but of course nobody knows the future for sure, so there would be some really nail-biting moments along the way, and you may never reach B at all anyway. Volatility certainly matters for emotional as well as financial reasons. The sheer stress of investments going wrong should not be underestimated. Now, by looking at the past performance of investments, you can get a feel for how volatile they usually are. The past, of course, isn't a perfect guide to the future, but taking it into account can help you assess the likelihood of a bumpy ride with any particular investment. Low-risk investors typically keep a lot of their money in cash in the bank. That's considered the safest place of all, because in the UK we get a lot of compensation even if our bank goes bust. There is a compensation limit per bank, which sometimes changes, so the Financial Services Compensation Scheme website can tell you the latest limits. The only problem is, keeping your money in the bank doesn't necessarily protect all of it, because of a little thing called inflation. Inflation refers to the speed at which prices go up in the shops. Say inflation is rising at 3% per year, but your cash in the bank is growing at only 1% per year. That means that prices are rising faster than your savings are. So your savings aren't going to buy as much stuff as they could have done the previous year. So that's why inflation sucks. And that's also why even low risk is on the lookout for investments that might provide a bigger annual return. Now, one notch up the risk-reward scale is government bonds. Remember we talked about lending money to the government in the previous video. You tend to get a pretty low interest rate, hopefully bigger than a savings account at least, but if you're lending to a major government, then the chance of them suddenly refusing to pay back their debt to you is usually very low. So it's considered relatively safe, but that's why they pay so little interest. Borrowers only tend to pay high interest when they're considered in danger of going bankrupt or just not being able to pay back their debts. So any time that you see regular high interest payments being offered for any investment, be wary and ask yourself why that interest rate is so juicy. Now, low-risk investors can consider buying some shares and funds too. The great thing about diversification is that if, for instance, you're putting most of your money into very low-risk stuff, then you can still put a small amount of it into something a bit more juicy, because if it goes wrong, then it's not a big part of your overall portfolio, so it's not that big a deal. And talking of juicy, medium risk is on the lookout for some juicy returns. So people in this position often head for the stock market, perhaps putting half of their investment money or even more into shares or funds containing shares. The stock market, of course, tends to go up and down, so medium risk investors often have the rest of their investment money in bond funds in order to diversify some of that risk, as we talked about in the previous video. Now, high risk has a lot more options. There are high risk shares and high risk funds to get stuck into. The returns can be absolutely stellar, but that possibility comes with the risk of losing a lot, maybe even most of their investment money. Even high-risk investing can be done in ways that can mitigate at least some of that risk, and you'll find out all about that later on in the guide. Now, without wanting to scare you witless, there is one more possibility that you need to keep in mind: the black swan. Yes, as an investor myself, this is the little critter that sometimes invades my dreams. A black swan is defined as an unexpected and unpredictable event that has an extreme impact. An example of this would be the COVID pandemic. An out-of-the-blue event like that would probably cause market crashes around the world. Depending on what happens next, those markets may recover, but how quickly is the question. So it's wise for even the highest risk investors to keep at least a chunk of their money in cash at the bank, just in case. Now, after all those warnings, all our risk characters are feeling a little bit lost at sea. Of course, it's scary when you don't know how to control your situation, but I bring good news. You can research your way back into a controlling position. Every investment you're considering can be thoroughly researched until you understand what you're entering into, and that should give you a certain amount of peace of mind as well as enhancing your financial potential. Now, when I first started investing, this was my idea of research. I invested in some absolute disasters when I first started, and I lost my savings. Listening to tipsters, even if they're your own friends or family, does not count as research. Real research into a company's share is about understanding what the company actually does and how it makes money. It's always high risk if you don't really understand what a company does or how it makes its money. So let's go back to our old friend MemePot PLC from the first episode of this guide. You remember that imaginary company that takes all your favorite memes and stores them for you in a handy pot up in the cloud, which you can access at any time? It's memes on tap, right? So we know what MemePot does, but crucially, how does it actually make any money? To find that out, we can check out the company's latest financial results. There are loads of websites that offer this publicly available information, but a good place to start is whatever stock exchange the company is listed on. In the UK, we have the London Stock Exchange, which includes AIM, the exchange for smaller companies. And we also have Aquis Stock Exchange, which is a newer exchange for growth companies. In the US, the top exchanges are the New York Stock Exchange and NASDAQ, which focuses mainly on technology companies. And in Europe, there's Euronext and a host of smaller national exchanges in each country. So if we go to the exchange website and search for MemePot PLC, we can find out loads of information. So let's start with the financial results. The primary pieces of information we need are MemePot's revenues, profits, and debt. We'll explore debt in episode 4. Meanwhile, revenue is the amount of sales the company had this past year. Profit is the amount of money left once all expenses have been deducted from revenue. Things like the cost of renting office space, paying workers, etc. You'll notice the profit figure is called EBITDA, which is one popular way of measuring profits or earnings for the year in the UK. It stands for earnings before interest, tax, depreciation, and amortization. Let's just call it profit, shall we? So this is a young tech company, so it's not surprising to see that the revenues and the profits are climbing fast. Reading the rest of the document tells us lots of useful information about MemePot. It says they get ad revenue from companies placing adverts that people see every time they access their personal MemePot. It's always useful as well to see what the boss has to say, particularly about future prospects. In the Outlook section, the CEO says they expect another big increase in revenues and hopefully in profits too next year. It can be particularly useful to scrutinize what the CEO says for any hint of negativity. They're usually so relentlessly positive about their own company that even if they just say that they expect challenging conditions, you can often assume that that means a pretty terrible outlook. Another key thing you need to understand is what sector a company is in. Even if a company appears to be in excellent shape, if the sector it's in is in trouble, then your company could still be dragged down with all the rest. For example, is your company a pharmaceutical company developing new medicines? Or is it a retailer? Or perhaps it's a finance company? Now, MemePot is a tech stock. Revenues look good, profits look good, future outlook is good, we're told by the CEO. But in this hypothetical example, let's say that people are writing articles saying that the whole tech sector is facing a supply crunch. There's a massive shortage of microchips due to worker strikes at a zinc mine. Zinc mine? Who cares? You need zinc to extract germanium. Who cares? You need germanium to make semiconductors. Who cares? You need semiconductors to make microchips. You need microchips to make computers. You need computers to have cloud storage. You need cloud storage for people to store their memes in your pot. Oh, now I get it. So, you can see how a company's sector can have wider implications outside of the company's own immediate concerns. We've covered a lot of ground in this video, so well done for getting this far. You've found out the basics of low risk, medium risk, and high risk investing. You've learned to avoid share tipsters who tell you what you should buy, unless they've got some genuinely useful and verifiable information about the company to tell you, then they're worse than useless and really will only lead you astray. They may say they know some secret information. They probably don't. But even if they do, that would be insider information, and it's illegal to buy shares using that information anyway, so really, just forget it. You've learned instead to do your own research using company financial results, information from the company's own website. And in addition, you may want to read other analysts' or journalists' views on the company's prospects. But always do take those views with a pinch of salt, as it's just one person's opinion, and they may or may not be correct in their assessment. Just make sure you understand how a company is making its money before you invest. That's the key thing. In the next video, we'll learn how to compare one company with another. Because you don't just want to buy some promising shares, right? You want to buy the most promising shares, don't you? Well, I do anyway. The most promising companies often end up with their share price rocketing. And that is, of course, the dream.